I think we are. Um, Facebook, Instagram, everywhere? No, okay. At the minimum, Facebook. So cool. All right. Yay. Brian, hey, hi. Thanks for joining
Hey,
us.
thanks for having me, Greg.
Of course. So I'm going to introduce myself really quick. My name, if you don't know, even though you follow me, is Greg Kuchikarslan. I'm a Los Angeles-based realtor, and I do these talks every once in a while to provide value to whoever's watching at the time. Brian, do you want to introduce yourself?
Sure, I'm Brian Mckim. I've been in the mortgage loan business since 2002. I work at a company called House America Financial. We're based out of La Cañada. We service all Southern California, Northern California, and I'm excited to be here. Thank you.
Yeah, of course. So the topic of today's chat is what to know about VA loans. We often hear about VA loans and how they're the best. And I thought a chat with a lender would be a great opportunity to deconstruct and to demythicize a VA loan and compare it to a conventional loan. So right off the bat, so some people may not even know, what is a VA loan?
Yeah, so a VA loan, it's a great loan product. You specifically have to be a military veteran with a eligible status to be qualified for a VA loan. But for those veterans and their spouses, it's a fantastic loan. The rates are excellent. The underwriting guidelines tend to be a little bit more flexible, and the best one of the best things about it is that a buyer and their spouse can buy something, no money down, and there's no mortgage insurance. So it's a wonderful loan. The loan amounts are very accommodating, which is important, especially in this competitive Los Angeles market. I just, in fact, closed a VA loan, and the purchase price was $925,000, and the buyers were putting very minimal down payment, and the rate was in the twos, and
Wow.
there was mortgage insurance. So, unfortunately, it doesn't apply. This loan product is not for everyone, but for our military veterans who are eligible, it is a fantastic loan product.
Amazing. And please correct me if I'm wrong, but survivors of veterans who never utilize a product can also use it. Is that right, or am I mistaken?
I do believe you're correct, Greg. It has been a while since I've had that scenario, so that's generally not what we come across. It's generally the veteran themselves that's applying for the loan. So I'll have to really do a deep dive on that and get back to you. But I do believe you're correct. Now, one thing that I want to mention is that typically co-borrowers are not allowed. So if you're married to the veteran, then that's allowed, but girlfriends, boyfriends, those non-married situations generally are not allowed.
Okay, understood. Is a veteran able to use the VA loan for an investment property that they are not planning on living in?
No.
No.
I've never done a VA loan for an investment property, and unless the guidelines have been recently updated, no.
Yeah. Okay, cool. Well, so what's the difference between a VA loan and a conventional loan?
Well, I think the biggest thing that stands out is the VA does not require monthly mortgage insurance when putting less than 20% down. On conventional financing, when a borrower is putting less than 20% down, some form of mortgage insurance is required. Usually, it's a monthly mortgage insurance premium that's paid, but it can also be rolled into the rate. It can also be paid for in a lump sum up front. But with conventional, less than 20% down, some form of mortgage insurance is required. On VA, there is no monthly mortgage insurance, which is great. I mean, it can be a savings to the borrower of $300, $400, $500 a month. So it's
Yeah.
pretty significant. Now, the VA does have what's called a VA funding fee,
Hmm.
and that can range um, from, well, it depends on the size of the down payment, if it's 0 down or 5% down, or if it's the first time it's being used, or if it's a subsequent use. But let's just say that funding fee ranges from 1% to 3%, roughly, and that's financed into the loan amount. So there is a funding fee. It's not a monthly expense, but it is financed into the overall loan amount.
Okay. And would that be considered a closing cost?
I wouldn't necessarily consider that to be an out-of-pocket closing cost.
Okay.
Like it is financed into the loan amount, but it's not something that the veteran and the spouse would have to come out of pocket for at closing.
Okay.
So,
All right. I understand that.
actually, it's not really a closing cost.
Sure. Yeah. Can we talk a little bit about what closing costs are? Sometimes that throws buyers through a loop. And I was wondering, from a lender's point of view, could you break that down percentage wise? And don't obviously have to take to like, oh, this part goes to title, this part goes to escrow. Rather, in a general encompassing term, what are closing costs when you define them to a client?
So, you've got closing costs that are due at the time of closing through escrow. Any lender or bank or credit union on a transaction, we don't actually handle any money.
Mm-hmm.
We send our funds to the escrow company, but the escrow company is the entity in the transaction that handles all of the money from the seller, from the buyer, from
Yeah.
the lender. So closing costs are monies that are, for example, on the buy side, they're monies that are sent from the buyer's account to escrow. And they're basically grouped into two categories. You have recurring closing costs, and then you have non-recurring closing costs. So the non-recurring closing costs are just what the name says. They're non-recurring. They're kind of one-time expenses that are tied to the transactional fees. So that would be escrow, that would be your lender fee, that would be your title insurance fee, that would be the appraisal fee. And so those are non-recurring expenses. And then you have recurring. And the recurring would be like per diem, mortgage insurance, prorated property taxes, prorated homeowners insurance. And those are items that are going to recur over the life or the ownership of that property for the owner, for the buyer. So hence, recurring property taxes, mortgage insurance, and then you've got non-recurring. So, I know sometimes we like to kind of give buyers like a percentage. The closing costs are going to, but especially in Los Angeles, it's hard to give a percentage because it's going to vary so wildly compared to a lower end property versus a higher end property. So if we say, closing costs are going to be, let's say, 2% of the purchase price, and somebody's buying a property for, let's say, $500,000, then yeah, maybe it's going to be around $10,000. That's a decent estimate, maybe a little bit on the high side. But if somebody's buying 800,000, the closing costs are not going to be $16,000. It's
right.
So, I mean, in most cases, the closing costs between recurring and non-recurring, I would say figure somewhere between $7,000 and $11,000 generally.
Okay.
You should reach out to a lender for a more accurate quote, but that's a decent rule of thumb.
Sure. Yeah. And to be super clear, closing costs are not part of the principal or the interest paid towards the house. It is simply part of doing business. If you go buy a bag of chips, you pay X amount of money that isn't part of the chips. You know what I mean? Some of that goes to taxes or whatever it may be. But sometimes people get a little nervous about using a VA loan and opt to use a conventional loan. Is there a specific reason why one might not want to use a VA loan and opt for using a conventional loan? Just because they think a seller might not um, want to deal with the VA loan? Is that something that you've seen or something that you should warn people about?
Yeah, I mean, I think there's a couple of situations where the VA may not be a great fit. And specifically on condominiums and townhomes, similar to an FHA loan, a VA can only be used when it comes to condos and townhomes, anything with an attached wall and an HOA, if the project is VA approved. And
Okay.
in my experience, I think there's more VA approved, active approved projects than in many cases FHA. So they are out there. I've done several VA condominiums and townhomes throughout my career. So it's definitely possible. But the reality is that not every project is going to be VA approved. So if you're in the market for a condominium or a townhome and you're really wanting to use the VA, you might find your search to be a little bit more challenging in locating a VA approved project as opposed to using conventional financing. And that designation is not required. You don't, you can use a conventional loan on pretty much any condominium or townhome project. So that's something to consider. Again, the great benefit of VA is that you could do no money down and no mortgage insurance. If you have to go conventional because you fall in love with this condo or townhome and it's not VA approved, you can put down between 3% and 5% down payment. So you don't need 20% for conventional. You can put much less down, but you will have some form of mortgage insurance. So just keep that in mind.
Totally. I'm sorry, really quick, Brian, I'm going to hop in. Does mortgage insurance last forever or does it go away eventually?
Well, it kind of depends on which form of mortgage insurance the buyer elects to use.
Okay.
Most of the time, it's a borrower-paid monthly mortgage insurance premium. And if that's the case, then no, it's not in place forever. At some point, that mortgage insurance can be dropped, can be eliminated without having to refinance, which if rates go up, then that'll be really valuable to have. So you could drop the mortgage insurance and not have to refinance. And the rules on that can vary from situation to situation. Generally, the mortgage insurance has to be in place for a minimum of 2 years. Mm-hmm. And then depending on how much the buyer pays down the principal and also how much the property appreciates in value, at some point the mortgage insurance can be eliminated.
Right on. Cool. And to be super clear, does the PMI, which is the mortgage insurance, does that apply towards any principal and or interest?
No, it's a separate expense. It doesn't. It is not applied to the principal balance.
Okay, cool. Good to know. So when somebody first reaches out and they're like, we want to use a VA loan, what's the first thing you tell them? What are some actionable steps that if somebody were to be like, hey, Brian, I like the way you talk. You're a smooth dresser. What do I do? I'm a military veteran and I want to take advantage of what's rightfully mine. What's action step number one?
Well, all these different loan products, whether it's VA or FHA or conventional or jumbo loans, I mean, the first step is all very similar. And, a good loan officer can kind of look at the data, look at the documentation, and kind of figure out what's the best fit for that client for what they're looking to do. But the first step is to get pre-approved. And the documentation for VA is a little bit different just because there are some documents from the Veterans Administration that we need to see, namely the certificate of eligibility That's a pretty important document that any veteran is going to want to keep on hand and have ready to go. The other form that's needed is the DD-214 form, a discharge paperwork. So we'll need that as well. But, outside of those specific VA documents, it's going to be things like paycheck stubs and a credit report and W-2s and possibly tax returns. And, we're going to want to know how long somebody's been on their job and what their position is, and is their income, is it just a base income, or is it commission or bonus or overtime? So all of those questions and all of those considerations are the same no matter what type of loan somebody's getting, whether it's VA or jumbo or FHA.
Totally. Okay, so does somebody need to be an active military in order to take advantage of the VA loan, or can they be a veteran, they've done their service and they're out, or do they have to be out and can no longer use it? Or is it interchangeable?
You can be active, or most of the time, the borrowers are generally not active, but not always. But no, certainly if you're out of service, and it doesn't matter if you're 20 years old or 60 years old or whatever it is, if you have that certificate of eligibility and if you've served in the military, then yeah, you can use the VA.
Okay, cool. And then, so let's just say, for example, that somebody uses a VA loan, they move into a place, and then turns out that they have to go somewhere else, the Midwest somewhere. Can they use their VA loan again, or do they have to pay off the property that they already purchased with the VA loan?
In all of my experiences, I've always had the person sell that home or pay off that loan before they use the VA benefit again.
Okay, understood. Now, let's just say, for example, somebody comes to you and says, I want to move into a place by October. When do you recommend that somebody should come talk to you about getting pre-approved? Should they go talk to you in October, or?
I would say don't. I mean, sooner is better, honestly. I think that applies to all loan products for all buyers. And if somebody's maybe looking in October, I think having a conversation now, let's say,
okay,
not a bad idea. Now, whether or not that person wants to go through the formal pre-approval process now, or maybe wait until spring, I think both of those could be good options. But I would caution any prospective buyer not to wait too long to go and speak with a lender or speak with a few lenders to get a feel and a flavor for service levels and rates and just accessibility and all that, because knowledge is power, and having the conversation sooner than later, I think, empowers the client to make smart decisions, to set up things in the best way possible. I mean, listen, there's no cost or obligation for going through this process with us. And so it's kind of like a free service, so to speak. Our goal is to try to help you, eventually when you go to take a loan out, we would love to earn your business, but the upfront process of looking through some income or credit or taxes is really valuable. And I wouldn't wait too long. So many times I've come across transactions or buyers situations where they may not think they're really looking, but then they might look, and then they fall in love with something, and then they want to make an offer, and then the whole process is kind of rushed, and maybe it closes and everything works out, but sometimes it doesn't. And so I think getting all the items reviewed and well positioned ahead of time just makes the whole process much more feasible, especially when the market is as competitive as it is now. It's so competitive. So
yeah, definitely. So is there a reason, or is there a possibility that a seller, if they get an offer on the table and it's a VA loan offer, is there any reason why that seller might want to, other than, poor biases, is there any reason that they might want to skip over the VA loan for a certain reason?
Well, yeah, I think that there is some perception out there that sometimes VA offers can be looked at differently as compared to conventional. Um, I don't always agree with those reasons, and let me give you some ideas on how you can get around maybe some of those objections. So I think, especially in this market, I would say, where values are rising and new sales are kind of touching the top end of the market in terms of what's sold recently. If a VA buyer comes in with a pre-approval and an offer with no money down, I think the seller in some cases might be concerned about, well, what if the house doesn't appraise? Then what is the buyer going to do? Do they have funds to cover the difference if it doesn't appraise? And so even if you submit the offer, let's say zero down, and you qualify zero down, maybe being able to show some additional funds just in case
Okay.
as reserve might make a seller more comfortable with the situation.
So for example, like a bank statement with all personal contact information blacked out, account information knocked out, just being like, hey, I have X amount of money in the bank attached to the residential purchase agreement offer. Is that something something like that?
Yeah, exactly. So showing the seller that there's additional funds to show the strength of the buyer, I think would always be a good idea if possible.
Regardless of VA loan or conventional, right?
Yeah, regardless of VA loan or conventional, yeah. But I mean, especially, I think with VA, I think the perception again is different. If a buyer goes in with a conventional loan, 20% down, I think the perception is the buyer is stronger, and that might be the case. That may not be the case, but especially I would say if you're going in to an offer with no money down, I think doing all that you can to kind of show that there's additional reserves or additional funds, I think would be reassuring to the seller or to the listing agent. So, and then, sometimes VA loans, the appraisals take a little bit longer generally. So on a conventional loan or a jumbo loan, we can usually rush the appraisal process and get that done in, maybe a week or so, maybe 4 days, maybe it's 8 days, but it's fairly quick. With VA, it's probably more like in the 10 to 14 day range because it gets run through the Veterans Administration back in Washington. It gets kind of reviewed by them, and that process can take a little bit longer. So, I think you don't, as an agent, I don't know if you need to necessarily stick to that, 17-day standard loan contingency in the contract, but maybe 12 or 14 days, tighten it up where you can, but generally the appraisals are not quite as fast. And I mean, other than that, I think it's a great loan. We do quite a few VA. They can certainly close. You can certainly get an offer accepted, but I think, you might, as a buyer, you might have to put a little bit of extra work in to maybe overcome some of those perception challenges that quite honestly are unfair, but that's kind of the reality of the situation.
Yeah. Which I think is kind of funny because I would always think that a seller might be like, they served our country, we want to serve them back. You know what I mean? Like I feel like there's like
too. Yeah, it all depends on the seller, but I've seen that happen as well.
Cool. Okay, so I think we should start getting close to wrapping it up. But Brian, can you tell us something that the average person may not know about the VA loan and how to take advantage of it?
Well, I mean, again, I would just say that it's a fantastic loan product. I mean, the rates right now for VA are probably ranging from 2.25% to 2.5% on a 30-year fix. Yeah, they're generally lower than your typical conventional loan or jumbo loan. So
my current clients have 2.7, and I'm like excited about that. And wow.
Yeah, okay. I mean, that's great too. But VA loans are even less expensive than conventional loans right now. So the rates are great. And the loan amounts are flexible. you can buy a fairly expensive home in Los Angeles or Orange County or Ventura County with minimal down payments using a VA loan and not have any mortgage insurance. So
Amazing.
it's a great loan. I mean, any veteran and or their spouse who is eligible for this type of loan should absolutely take advantage of it. It's a great benefit from serving the country, and it's a great loan. So
yeah,
there's no reason not to use it, and work with a good loan officer, somebody who's local. Hopefully, I mean, a lot of these credit unions and whatnot, they're not bad, but typically they're out of state, and they can be a little bit slow.
Yeah.
Hard to get a hold of sometimes, but I would recommend somebody local who knows VA loans and do it.
Heck yeah, I love that. So I'm gonna. So here's what I got out of our conversation. A VA loan is a great product. It has some very minor pitfalls that maybe shouldn't be taken too seriously, or have been unfair. I'm also thinking that. Oh, we got a question coming through, and it gets different rates for different counties, right? Is that right?
No.
So for Orange County versus Los Angeles County, are there different rates?
Not with our company, and I would say most companies probably not. No, maybe different states might have different rates, but I'm only licensed to do loans in California, so I don't really deal with other states per se. But no, I mean our rates are the same depending on whether or not it's LA or San Diego or Orange.
Okay, cool. So actually, I'm gonna extrapolate on that question. So let's just say somebody came to you and were like, "I'm thinking about buying in Orange County," and then they find a dream house in Los Angeles County. Do they need to come talk to you and be like, "Hey, I changed up where I want to live," or is that a non-issue?
I would say technically it's probably a non-issue, but I think to your question, I think having that open dialogue as you go through the process is super important. So
Okay.
I think your lender and agent and client buyer should all be on the same page. So yeah, I mean, if you're changing your areas and price range and type of property from one geographic area to another, and you want to run numbers, yeah, I definitely think that's an important conversation to have.
Okay, fair enough. And I was thinking of wrapping it up and being like, okay, these are the questions that, or at least the bullet points that I got out of it. Or actually, if anybody has any other questions, throw it in, toss it in. But what I've gotten is that the VA loan is a strong, strong product. If I remember correctly, I'm a little bit of a history buff. It came about after World War II because the government kind of realized that a bunch of younger men and women were coming back and not going to be having jobs, and to stabilize and stimulate the economy, the VA loan was born. I could be completely wrong with that. I'll fact check myself in my own comments, but I like to think I'm right. Brian, do you mind if we close this up? I toss your contact information in case anybody wants to reach out to you for random questions.
Yeah, that's great. Yeah.
Cool. Please. Awesome. We got another one coming through. Let's show this right quick. I got another one from Maria. What's the pre-approval process like if you didn't talk about that?
Yeah. Hey, Maria. So the pre-approval process is pretty easy, honestly. It's a little bit of a chore for the client to gather up the documentation. Yet another reason why I think doing this sooner than you may think you need to is important, because it does involve, maybe setting 30 minutes aside or an hour aside and kind of gathering bank statements and W-2s and paycheck stubs. And I'd recommend, scanning them or having some sort of soft copy so that if you want to shop around or talk to some different people, you can easily, send the information. But, we try to make it easy and fast. Basically, it involves looking at a credit report. We look at generally 2 years of W-2s, the most recent 3 to 4 paycheck stubs, the most recent 2 months of bank statements. And so we want a complete picture of the file in terms of income and assets and credit. So that way we know exactly what you'll qualify for. We can give you and your agent good information. And we're really trying to underwrite the file up front. That's kind of the mission. We want to underwrite and review the file up front, so that way you're ready to go, you're solid, so that once your offer is accepted, you're not going to have any question marks when it comes to financing. So generally it's completed same day. So if we get the stuff in the morning, generally by midday or the afternoon, we can have it finished. Certainly within 24 or 48 hours, it's done.
So nobody needs to even come see you in person. Not that they don't want to see you in person, but I mean, everything can be done online with little stress as possible, right?
Yeah, especially this year, 2020. Everything is this, it's all Zoom and FaceTime and email and stuff. So yeah, it's all electronic and telephone and text, a lot of text messaging. So yeah, all of it's kind of virtual now.
Would you be opposed to, and please say no, and I'm putting you on the spot right now, if somebody wanted to video chat with you privately, is that something that you offer before they even go through the pre-approval process?
Yeah, I've done that a few times. It's kind of fun. Yeah, we could do a Zoom, or certainly a phone call is probably more common. But yeah, I mean, however somebody wants to connect, pretty open to accommodating whatever they feel good about.
Amazing. I think that's it for me. If somebody else wants to throw another question, I'll feel free. No question is too embarrassing. No question is too dumb or whatever. But if something comes through, I appreciate you for sticking around, Brian. I'm tagging you in the post on Facebook. I'm sorry that I couldn't get Instagram to work for the people who had to quickly scrounge their Facebook up. I apologize. I hope to work out those kinks sooner rather than later. Brian, thank you so much. I appreciate you. Good night to those of you who are watching. Good night, Maria. Thank you so much for asking questions and helping stimulate the conversation. All right.
Thank you. Thanks, guys. Thanks, Greg.
Good night.